For decades, New Zealand has been the envy of the world, a country of breathtaking beauty, political stability, and a reputation for good governance. The world saw it as a paradise that somehow managed to combine economic growth with a high quality of life. Economists once called it a rockstar economy. But in 2025, that story has changed. The same country that once topped the global rankings for prosperity and livability is now facing its most severe economic squeeze in over 3 decades. The government's books are strained, productivity is flat, real incomes are falling, inflation, though slowing, has already eroded household savings, businesses are closing, and record numbers of citizens, particularly the young and skilled, are packing up and leaving. How did one of the world's most admired economies end up running out of money? This is the story of why New Zealand is running out of money and what it will take to stop the decline. Let's start with the fundamentals. New Zealand's economy, worth around $385 billion NZD, has long relied on a simple formula: natural resources, tourism, and property. For years, that worked the global demand for dairy, meat, and timber-filled government coffers and supported a stable currency. But beneath the surface, the country's growth model depended heavily on private debt, foreign capital, and rising asset values, not on productivity or innovation. As of 2025, household debt sits at 167% of disposable income, one of the highest ratios in the developed world. Government debt, which was below 20% of GDP in 2019, has more than doubled since the pandemic, now hovering around 47% of GDP. New Zealand isn't bankrupt, but its fiscal headroom, its ability to borrow, invest, and respond to crises has shrunk dramatically. When people think of New Zealand's wealth, they imagine dairy farms, vineyards, and pristine exports labeled "Made in New Zealand." And while those sectors are valuable, they tell only part of the story, and a fragile one. According to Statistics NZ, nearly 60% of all goods exports come from just a handful of primary commodities: dairy, meat, logs, and a few horticultural products like kiwi fruit and apples. Dairy alone accounts for $18 billion NZD annually, nearly a quarter of all goods exports. But the catch? Over a quarter of those exports go to China, tying the country's economic fortunes to a single trading partner. Meat exports add another $8.4 billion, forestry roughly $5 billion, and horticulture $3.5 billion. But most of these products are exported raw or barely processed. Logs are shipped to Asia for processing. Dairy is sold as powder, not as branded high-margin consumer goods. The result is an economy that earns like a supplier, not a manufacturer. It's like owning an orchard but selling the fruit unwashed and unbranded while someone else makes the juice and the profit. In 2025, New Zealand ranks 50th globally in the Economic Complexity Index, a measure of how diverse and technologically advanced an economy's exports are. Countries like South Korea, Finland, and Singapore rank near the top. New Zealand's economic base remains narrow, leaving it dangerously exposed to commodity price swings, climate shocks, and shifting demand. If the export base is narrow, the domestic economy is distorted. For years, property was New Zealand's favourite investment, a national obsession. Homeownership wasn't just cultural, it became a financial religion. Real estate services now make up about 11% of GDP, and construction adds another 6%. Together, nearly a fifth of the entire economy revolves around property. Over the past decade, house prices rose by 130% nationwide. The median home now costs 8.8 times the median household income, nearly triple what the OECD considers affordable. The housing boom made many homeowners rich on paper, but it also drained capital away from the productive economy. Businesses found it harder to raise funds, while households poured savings into mortgages instead of startups or innovation. And now, that boom has turned dangerous. Roughly 40% of all home loans were taken out when interest rates were below 3%. As those loans roll over at 6% or higher, repayments for many families have doubled. Mortgage stress is spreading fast. According to the Reserve Bank, over 20% of mortgage holders are now at risk of financial distress if interest rates stay high through 2025. Consumer spending is slowing, small businesses are seeing less foot traffic, and property-related tax revenue is shrinking. In short, the nation's wealth is locked in houses that can't pay the bills. For years, New Zealanders were told the economy was booming, and it was on paper. GDP was growing, wages were inching up, and foreign investors were flooding in. But the prosperity was an illusion. Between 2012 and 2022, labor productivity grew by just 0.3% per year compared to 1.5% across the OECD. That means most of the growth came not from people producing more, but from working longer hours, taking on more debt, and watching property values rise. This is the heart of New Zealand's economic problem. Wealth has grown faster than value creation. The economy looks richer, but the underlying productivity, the ability to produce more per hour, per worker, has barely moved in a decade. This weak productivity explains why wages remain low, why prices keep rising, and why even full-time workers struggle to get ahead. It's also why the government's tax base is too small to fund big social programs without new debt. Simply put, New Zealanders are working harder but getting poorer. Why hasn't productivity improved? The answer lies in chronic underinvestment. New Zealand spends just 1.4% of GDP on research and development, barely half the OECD average. Compare that to South Korea at 4.9% or Sweden at 3.5%. Low R&D spending means fewer high-value industries, fewer startups, and fewer export-ready innovations. Universities struggle to commercialize discoveries, and small businesses lack access to venture capital. When economies stop innovating, they stagnate. And stagnation is exactly what New Zealand faces. The result is a country that exports raw milk instead of biotech, timber instead of engineered wood, and talented graduates instead of world-changing ideas. One of the clearest signs of an economy running out of money is when its people leave. In 2024, 128,700 New Zealanders left the country, the largest annual exodus in history. Many are highly skilled engineers, doctors, and IT professionals heading to Australia, where wages are on average 26% higher. In some industries, the pay gap reaches 200%. That's not just a lifestyle decision, it's survival economics. These departures aren't just young people on a working holiday. They include mid-career families, professionals, and retirees joining their children abroad. Once they leave, most don't return. This outflow has real costs. Small towns are hollowing out, schools are closing, local businesses lose their customer base, and public services from hospitals to fire stations struggle to stay staffed. It's not just a brain drain, it's a wealth drain. When COVID hit, New Zealand acted fast. The government locked down early, shut borders, and unleashed a massive stimulus program. It worked at first. The economy avoided immediate collapse, and unemployment stayed low. But the aftershocks were severe. Low interest rates and pent-up savings fueled a property frenzy. Then, as inflation surged, the Reserve Bank of New Zealand overcorrected hiking rates aggressively, even admitting it was aiming for a technical recession to cool demand. It succeeded. The economy contracted, business confidence plunged, and unemployment climbed to its highest level in 4 years. Meanwhile, fiscal tightening hit at the worst possible time. Thousands of public sector jobs were cut, especially in Wellington. Infrastructure projects were delayed or cancelled. By the end of 2024, HSBC ranked New Zealand as the worst-performing developed economy in the world. Stimulus had turned into austerity, and confidence evaporated. The nation had gone from protecting its economy to suffocating it. Beyond the short-term crises lies a deeper, demographic one. New Zealand's population is aging rapidly. Today, 18% of citizens are over 65, and by 2034, that number will reach 21%. That means fewer taxpayers and more retirees drawing pensions and healthcare services. Superannuation already consumes a massive portion of the national budget, and it's rising fast. At the same time, fertility rates have fallen to 1.6 births per woman, well below the replacement level. That means a shrinking workforce is now expected to support a growing elderly population. Add to that the soaring costs of healthcare. New Zealand has the third highest obesity rate in the OECD, and the result is a fiscal time bomb. Without structural reform, future governments will face a painful choice: cut services, raise taxes, or borrow even more. Behind every modern economy lies its infrastructure: the roads, hospitals, water systems, and power grids that keep it running. In New Zealand, these are falling apart. Experts estimate the infrastructure deficit at between $200 billion and $400 billion NZD. Roads need rebuilding, rail networks are outdated, and water systems in cities like Auckland and Wellington are under crisis. Every year of delay makes the repairs costlier. The longer New Zealand postpones investment, the more it pays later with interest. The irony? This infrastructure decay doesn't just hurt daily life, it also stifles economic productivity. Poor transport networks limit trade. Weak digital infrastructure limits innovation. And inefficient utilities push up living costs for everyone. Even as wages stagnate, the cost of living keeps climbing. In 2025, inflation has cooled from its peak, but remains above 3%, driven by housing, energy, and food. A typical Auckland household now spends 35% of its income on rent or mortgage payments, one of the highest shares in the OECD. Groceries are 25% more expensive than in 2020. Fuel prices remain among the highest in the Pacific region. Electricity bills are soaring despite government subsidies. In short, New Zealanders are paying more for less, and the middle class is shrinking fast. So where is the money going? Tax revenues have stalled. Corporate taxes are falling as profits decline. Income taxes are weighed down by weak wage growth. And the government's operating deficit widened to $11 billion NZD in 2024, the largest in years. Meanwhile, welfare spending has surged. Over 400,000 people now rely on government support. The math is simple: lower productivity, higher costs, and growing social pressure. The government can't cut spending without hurting people, and it can't borrow endlessly without risking its credit rating. It's the classic middle-income trap, now playing out in one of the world's most developed nations. New Zealand's economic problems aren't destiny, they're design. The country must rebalance from consumption to creation. That means investing in high-value industries beyond agriculture, boosting research and development spending, reforming the housing market to channel savings into businesses, not empty land, fixing infrastructure to unlock productivity, and creating incentives for young talent to stay, not leave. This isn't easy, but it's possible. New Zealand has done it before. It transformed from a closed, protectionist economy into a modern, competitive one. Now, it must reinvent itself again, not through austerity, but through ambition. New Zealand is still one of the world's most beautiful and peaceful nations. But behind that postcard image lies a troubling reality: an economy running on fumes, households living on credit, and a government running out of fiscal space. This isn't just about money, it's about the kind of future New Zealand wants. Will it continue to drift dependent on property and commodities, losing talent, and watching inequality rise? Or will it rebuild its foundations, invest in innovation, and create a new kind of prosperity, one built not on luck, but on productivity and purpose? The answer will define the next generation. Because the truth is simple: New Zealand isn't poor, but it's running out of money in all the places that matter most.